Let's be honest, the main reason most people get curious about crypto is the potential to make money. You've heard the stories, seen the headlines, and maybe felt like you missed out. That's perfectly normal. The good news is, you absolutely don't need to have been early to the party or already be wealthy to start making money with crypto. The opportunity is still vast and accessible. What you do need is a sound strategy, a good dose of patience, and a willingness to understand how things work. It's not a magic button, but it is achievable. Our goal here is to give you a realistic, actionable roadmap. We'll break down the different ways you can approach making money in this space, even if you're starting from scratch. When we talk about making money with crypto, we can generally group the strategies into 4 main categories. Think of these as different paths you can take, or even combine. The first category is buying and holding, which is essentially long-term investing. This is often the most recommended starting point for beginners. Next, we have trading. This involves trying to profit from short-term price movements, buying low and selling high more frequently. The third category is passive income. This is where your crypto works for you, earning rewards through methods like staking or lending. Finally, there's earning crypto. This involves getting paid in crypto for work, participating in reward programs, or receiving free tokens through airdrops. Let's dive into the first strategy, buying and holding. This is often called hodling in the crypto community, which is just a fun misspelling of hold. The core idea is simple: you buy a cryptocurrency and hold onto it for a significant period, usually months or even years. You're not trying to time the daily ups and downs. This strategy works because you believe the value of the crypto you buy will increase substantially over the long term. You're betting on its future growth and adoption. The benefits are significant, especially for beginners. You avoid the stress of constant market timing, you pay fewer trading fees, and you position yourself to capture major long-term growth cycles. Patience is absolutely key here. This strategy is about letting your investment mature over time, not trying to make quick profits through frequent trading. Choosing which crypto to buy is a crucial step in the holding strategy. For beginners, it's wise to stick to established, trustworthy coins that have proven use cases and staying power. The 2 most recommended starting points are Bitcoin and Ethereum. Bitcoin is the original, often seen as digital gold, and Ethereum powers a vast ecosystem of applications. Other strong options include established Layer 1 blockchains. These are the foundational networks like Solana, Avalanche, Cardano, or Polkadot, which host other crypto projects. Be very cautious about hype-driven coins or those promising overnight riches. These are often highly speculative and carry much higher risk, especially for newcomers. Before investing in any coin, do your homework. Understand what problem it solves, who is on the team, and if it has a growing user base or active development. Now, let's talk about how much to invest. This is perhaps the most important rule in all of investing, not just crypto: never invest money you cannot afford to lose. Crypto is volatile. For beginners, we strongly recommend starting small. Think £50 or £100, just enough to get familiar with the process and the market without risking significant funds. A fantastic strategy for beginners is dollar cost averaging, or DCA. This means investing a fixed amount of money at regular intervals, like £20 every week or £100 every month. DCA helps mitigate risk because you buy at different price points, averaging out your cost over time. You buy more when prices are low and less when prices are high. Crucially, DCA helps you avoid emotional decisions. You stick to your schedule regardless of market sentiment, preventing panic selling or FOMO buying. So, where do you actually buy crypto? For beginners, the easiest and safest places are large, regulated centralized exchanges, SEXs. Think names like Coinbase, Binance, or Kraken. Once you buy crypto on an exchange, it's generally held in a wallet controlled by the exchange. For enhanced security, especially for larger amounts or long-term holding, it's important to move your crypto to a personal wallet where you control the private keys. This is where the saying "not your keys, not your coins" comes from. Keeping track of your investments is important, but it doesn't need to be stressful. Use portfolio tracking apps like CoinGecko, Delta, or CoinStats to see the value of your holdings. Resist the urge to check your portfolio every hour or even every day. For a long-term strategy, a weekly check-in is more than enough and helps avoid emotional reactions to short-term price swings. One of the hardest parts of investing is knowing when to sell and take profits. It's easy to get greedy when prices are rising or panic when they fall. A recommended approach is to set price targets in advance, based on your research and investment goals. Decide beforehand at what price points you will consider selling some of your holdings. Implementing a tiered exit strategy is very practical. Instead of trying to sell everything at the absolute peak, sell in small amounts as the price rises towards your targets. This allows you to secure wins along the way and reduces the risk of the price crashing before you sell. You lock in gains incrementally. Once you sell, you can move your profits into stablecoins, which are pegged to the value of fiat currencies like the US dollar, or withdraw them back to your bank account. This secures your gains from crypto market volatility,